to show you guys exactly how you enter into calls and puts, and we're going to be using the Webull app. Now, usually if you're using other apps, Thinkorswim, Webull, let's see, Taste to Trades, Robinhood, all of them, you can find on there somewhere the same exact, well, not same exact steps, because of course the platforms are looks differently, but when you are entering calls and puts, you just simply look for the options section on whatever app you're using so that you can enter into calls and puts for whatever stock you want to trade. You have the Webull app, okay? You're going to go into the app. When you first open the app, depending on what platform layout you have your Webull app set on, mainly the main thing you're probably going to see is your watch list. Okay, so I have the pop-up here where you have your watch list, and then at the very bottom you're going to see markets. So you're going to click on markets, and on that very top row you're going to see options, and you're going to click on options, and it's going to bring you to the options center in the app. Okay, so you can pick whatever stock you want to, but if you want to follow along directly with what's on the screen, then you just pick that one. Okay, so we see Tesla, Nvidia, Palantir, Amazon, and Apple. So I'm going to pick Apple. You click the stock, it's going to bring you to the chart. As you can see, I already have like a lot of my indicators, my RSI, my MACD, I have my EMA set up and all of that already here for me to pretty much allows me to kind of open the app, look at what's going on, if it's touching EMAs, what's going on with the stock on whatever particular time frame. Okay, so these are just things on that page that you can take a look at prior to going into actually opening a position on the option trade. When you get to this page, you will see options at the bottom next to trade and at the top right in between chart and news. When you click that, it's probably going to open up the options chain, or it may take you to the options discover page, and it will look more cleaner for you to be able to just select bullish or bearish, select your strategy, and then go ahead and open your position. But I would rather some of you, especially if you're new to it, to go to the option chain so you can get a little bit more detail on what it is that you are selecting. Do a really quick overview of the option discovery page. It says my outlook on Apple is bullish, bearish, neutral, or volatile. Now, depending on when you did your application with Webull, if you're level 1, 2, 3, or 4, you may not even be able to trade the neutral, the last two, okay? Because it keeps you where they believe that you are more experienced at, or whatever you set up on your Webull application. So more than likely, you will be able to just simply enter long calls or long puts and only use the bullish and the bearish. When I first opened my Webull account, those were the only two that it allowed me to select until I upgraded the level on my Webull, kind of just saying, where am I as a trader? We're going to keep it simple. So if you believe that the stock is going to go up, then that just means you're bullish on that stock. If you believe it's going down, that just means that you're bearish. So because we're talking about shorting the market because of a potential market crash tomorrow, we are going to be bearish. So you will hit that one and you will enter into a long put. Okay, now it's going to bring you to this page, and it's going to be a very simple layout for you to be able to select your strike price that you want to enter and to select your expiration date. One thing that I want to mention when it comes to the expiration, your expiration lets you know how long that option is going to be good for. If you select the expiration for the next 3 days, that's basically saying that this option will expire on Friday. If you do not close that position by then, that option is going to disappear or exercise on your behalf. So if it's out of the money or it's worth nothing, it just disappears. And so if it is in profit and you are ready to close it and take your profit, close the position before it expires. But just know that you do not have to hold until the expiration. You can close out your play whenever you want to. It's just important to have time on your side. That is what that top bar is, where you have 3 days, you got 10 days, and you have all of these. You can go all the way up until next year, however long you want to hold a play. Now, let's look at the strike price. The strike price is just what it says. It's a strike. It's a target. That is the price that you're looking for this particular stock to come down to. Now, one thing about the strike price is you have 3 types of strikes. You have in the money, at the money, and out of the money. This $222.50 strike price on a put for Apple is in the money. Okay, and in the money is just basically saying that this is a already profitable option. But keep in mind, we're markets closed, and so tomorrow that chain is going to reset. So the things that are in the money or out of the money or at the money may be in different spots tomorrow once the option chain reset. Now let's go down and look at this bottom. You have max loss, price, profit probability, your delta, your max profit, and your break even cost. Now you can edit what you want to see down there, right where it says to edit your metrics, and you can put what you want. You have the Greeks, which you have the delta, the gamma, theta, vega. You have the premium paid, bid, X, all of that stuff. You can put all of that there. Me personally, I like to keep it simple, even when I'm using this, or I use the options chain so that I can kind of get a full picture of what other strikes are available. Now, you see where it says max loss, $260. That is the premium that you will pay to enter into this particular strike for a 3-day expiration. Now you may say, I don't have $260 to get into it, or I don't want to put $260. I'm new to it and I don't want to risk too much. Let's say you only have $50. You're going to have to go and find a strike price that only costs you $50 to enter. So the minus sign, we're going to go down. It's probably going to be like 212, 200 maybe. Let me see. It's not a $50 one, but the 212.50 is $45. So that means the premium is going to cost you $45 to enter that play with one contract. Now, let me also say this too. One contract equals 100 shares. So this says $45, but on the option chain, it might say 45 cents. You would do 45 cents times 100, and it would bring you this $45 total premium that you will pay. And the reason it says max loss is because you can only lose an option what you put in as your premium. Let's look at the delta that you see. The delta is important because this tells you how much your option is going to move per dollar. Now, you see we went out of the money. This 212.50 strike is out of the money. Therefore, the delta is also going to be low, meaning that with this delta, it's going to take a little bit longer for you to see some movement. So let's say you get a 212 strike and I get a 222 strike, and you're trying to figure out why is mine in profit and yours isn't. That's because it's taking a little bit more time for your strike and that option position that you entered to see some movement because the delta is not as high as mine. Let's go back to the 222. And that delta is 42 cents. Okay, so that means that option is going to move 42 cents per dollar that that stock moves. So I will be seeing profitability much faster, and I will be seeing higher profitability versus what you may be seeing for a short period of time. That is why having a high delta is super important, especially when you're not trying to be sitting in a trade all day. Because if your delta is too low, it's going to take you forever to see some type of profit. Now, if we go lower than 212, that delta is going to go down. So let's click here. Let's go to like a $200 strike. The delta is 92 cents. You're only going to get 2 cents per dollar that thing is moving. So if it's moving slow, and one thing about Apple is Apple takes about sometimes a week, two, maybe a month to see its most significant move. So you're going to be holding that play for a while just to be able to see some profit because of how low that delta is. Now you can one thing to also note is that the delta amount can change. The delta can go from 2 cents to 1 cent. It can go from 45 cents to 50 cents. It has the ability to move, but that comes along with the other Greeks, but that's a video for another day. Before we go to the options chain, as you see, the further down we go on the strike price, the lower it costs you to enter. To get into a $200 strike, to say I have a $200 target on Apple, it's only going to cost you $11. So you may have a little bit of money to put in, but just know that it will take longer to see profit unless that stock is making some significant moves while you are holding it. One last thing, when you go higher on your expiration, the premiums will cost more. So to show you that before we go to the option chain, you see how we have a $200 strike and it costs us $11 to get. Now let's go into a 10-day expiration and we're going to go to the 200 and it costs us $36. You see how it increased? Basically, when it comes to getting higher expiration, you're pretty much paying for time because you're just getting time on your side and giving you more time to hold your position versus one that closes out in a few days. So the higher you go on your expiration, expect to pay more for the premium. Let's go back to the option chain, okay? So now that we're on the option chain, you see where it says ITM? You have ITM, ATM, and OTM. In the money, at the money, and out of the money. Everything up here is in the money. Why? Because everything up here is already profitable. Because this price is $223. That's the stock price. Now, you have $222.50. Remember, I already said that was in the money. That's the same price, or well, not the same price. It's right under the price that the stock already is because we are betting on the stock to go down. Then when you go up, you see you got 220, like it's already past 220, right? So therefore, it's already in the money. And these option plays up here will result in you having to pay more on your premium. Now, at the money will be one that's equal to 223 or very close to 223, but it's not under it. I hope that makes sense. So the 225 will be at the money. Now, you have these ones at the bottom. Let's go further down. You see where it says 3 cents, 1 cent, well, 0 cent. Those probably you can't even fully select, or you will have to kind of put a bid in. But you see how low they get? These are out of the money options. And the further out you go, the lower it will cost you to enter into that premium, okay, or to enter into that play. And a lot of times, you may see it's super low, but you have to ask yourself, is it worth it, and how long would you be holding it? Going that far out of the money to get a cheap option probably would not be worth holding for 3 days, because that stock will probably not make some significant move in just 1, 2, 3 days. Okay, you will want to get something a couple weeks or a month out to have a chance of seeing some sort of profitability when you go that far out. Depending on how you have it set up, at the very bottom where you see single option, and then you see calls right here. Okay, so we will hit calls and you will just hit puts if we're betting on the stock going down. Okay, so you want to be sure that you are on the right one. Make sure that you're on puts or calls, whichever one you are looking to select, or whichever side of the play that you're looking to go. Okay, so because we're looking for it to go down, you want to be in puts. Now we're going to select this let's just say this 225 one. Okay, so it's going to take us to this page. Now, you see where it says limit price? You don't have to pay that $385 off the bat. You can say, I want to wait for it to come down some so that I can pay a little bit lesser for it. That way, you can try to get the maximum on your profit. So if you look at the chart that's up here at this top, right, that's telling you where the price has been going. It was up at 505 at one point. And let's see, it was 502, then we got $3.44. You say, okay, I only want to pay $300 even for it, or I want to pay that lowest price that it was in a certain period of time. So you would just kind of come here, or you can click on it and you can pay the bid, the ax, or you can pay the mid. Me personally, I always go 10 to 15 cents lower than whatever the amount is, so that once it pushed back there, then my play executes and then I work from there. Okay, so you can put that, you want to pay 300, but keep in mind that play will not execute immediately. You will have to wait for that option value to come back to $3 before it executes, and then you will be able to start seeing your play move. Now you have the contracts here. Now with the contracts, like I said, is times 100. So yes, you see $3, but it's going to cost you $300 to enter into that play. Okay, so the more contracts you have, the more profits you will see. But you have to also remember it will double. So if you got 2 contracts to enter this premium, it's going to cost you $600. If you got 3 contracts, it's going to cost you $900. You are multiplying whatever your premium cost is times 100. Okay, so if it's times 200, times 300, how many other contracts you get? I'm going to switch it to the paper trade so that we can go through this whole thing and actually hit and submit, but it won't execute until the market opens, especially if you have like a certain price. Even once the market opens, it's still not going to execute until it reaches the amount that you set. Now you can do a limit order or you can do a market order. Market order is saying I wanted to execute at whatever price that is currently trading at. Okay. So once you do that, you select whatever you want that price to be and then how many contracts you want. Okay. So if you're new to this, I highly recommend starting with one contract. Don't overdo it on your position. Once you do that, you can do time and force, which is day or good to cancel, meaning that if it does not get back to $3, then just close it out at the end of the market day, or just keep it open until it comes back. That is the good to cancel. You can cancel it at any time if you're tired of waiting for it to reach whatever amount that you want. Okay, so you can do day or good to cancel. Once you do that, okay, you have your put all set, and go back and we're going to put that $3 in. Just say we wanted to be at $3. Okay, and then we are going to go back and then we're going to mark our order. So this thing will execute once it hits $3, or however you want to do it. You want to pay whatever that market so you can go ahead and start seeing your play in action, or you want to wait for it to come down some so that you can get a little bit off and then ride it back to whatever direction that you want to ride. So this is just using the Webull app. I highly recommend paper trading. This is just where we did this particular trade. You see at the top in the right hand corner where it says PM, that is paper market or paper trading. Okay, that can give you some footing into getting your feet wet with it a little bit, or where you don't have to risk any real money tomorrow, but you want to enter in some puts for some companies, S&P 500, Tesla, Target, whoever, and ride a stock down or just see what happens. So you can see how the market reacts to tariff news. You can see how options move and things like that. So I highly recommend paper trading if you are not comfortable yet or you don't fully understand how to option trade. So that is just something that I wanted to show you guys, because if the market does crash tomorrow, there are going to be people making crazy money tomorrow just from stocks going down. This is what it means to short the market. And then when things start back getting bullish and everybody's riding back up, that is just where you enter to calls, because you're betting that things are about to go back up.